Let's get to our closing bell exchange to start the second quarter with the Dow down just 23 points right now. David Waddell from Waddell & Associates joins us today. CNBC market analyst Steve Grasso from Stuart Frankel is at post 9. And CNBC contributor Jack Barugian from UCX is back with us again from Chicago. Steve, here we go again. Another one of those buy the dip kind of days that I mentioned. At the low of the day, the Dow was down 145, and now we're down just 23. What's going on here?
Yeah, you know, you always, as a trader, you always look for that standout headline, and I don't really see one right now. You see mega tech, you see Apple sort of leading that bounce back. You always try to point to maybe a European close where they feel it's safer to come into equities, U.S. equities. But I have no real headline that really sticks out as the catalyst for the buy off the lows, other than the fact that we've seen this time and time again. No one really wants to sell them. No one wants to buy them. Sort of want to sit in the middle here until something out of D.C. D.C. is definitely leading the trade. And if we're more optimistic that something is going to get done as far as tax policy, people say, you know what, I'd rather be in equities than continue to miss the rally that they've missed since November.
Yeah, and David, you're saying even if Trump never gets a legislative win, the markets can still rise. It's just a question of what that rise will look like, right?
Yeah, I think Steve's right, and the rise will look a lot like the way the market behaved in 2015, for instance. I think the FANG stocks win. You know, we heard about Tesla, so maybe that wins. You know, maybe you get the Fed scaling back a little bit and you get the weaker dollar trade. I mean, there isn't a reason for this market to tip into recession, so there's no reason for it to fall apart. But we could move past this sort of secular stagnation trade into a stagflation trade if we never, ever get anything out of the Trump agenda.
You know, speaking of that, Jack, we were all watching the 10-year yield, which is now down to 234 today.
Yep.
And I wonder what your thought is. I mean, is this a market that is sensing that there's a slowdown? We got the auto sales out. The New York Fed on Friday reduced its second quarter guesstimate for what growth will be for this quarter. I mean, what's going on with the treasuries right now, do you think?
Now, Bill, that's a great observation. In fact, you know, the action in that 2-year, the 10-year, and the entire yield curve, for that matter, is very confusing for a lot of equity traders. You know, I've always had the argument, which market is right? Is it the equity market or is it the bond market? This time around, it's starting to feel as if bonds might be right, especially when you're looking at that 10-year yield, especially when you see what's going out in Europe. And all of this is kind of revolving around, you know, lowered expectations for earnings growth. Remember, without that 10% growth that we expect in the S&P 500, we're priced too high. And all of this, and if you're bullish, and I am a bull, you know, you don't like to see the kind of start to a quarter and a month that we saw today. You know, the real question, Bill, that we should be asking is the market starting to ask perception versus reality, all right? And that's really the question that we hear traders talking about. Are we going to get the reality that people have been talking about?
Yep.
And on that point, David, you know, I know you mentioned stagflation, but when you got a 10-year 2.34%, I can see the stag. It doesn't seem to see the inflation.
Well, we did get the inflation above on the PCE, that 2% mark for the Fed. You know, we are seeing some capacity constraints, so what would be kind of nasty is that we get into a little bit of inflation because we're capacity constrained, but we don't get the growth on the other side. Now, that doesn't necessarily mean the market falls apart, but if you go back and look at stagflationary periods, not real good for stock investors, not real good for bond investors. We really need the tax reform if we really, you know, want to do anything about unlocking more earnings and unlocking more economic growth.
Yeah, see the late 1970s. Before I get back to Steve, Dave, you've got a trade that you feel it would be based on whether or not we get a tax reform bill of some kind. What would you be buying if we do get tax reform, for example?
So if we get tax reform, then the reflation trade comes back, and the center of that target really is small cap, U.S. stocks, financials specifically. And then if we don't get that and we stay mired in the secular stagnation trade, then you'll probably see the dollar come down, and now people are starting to get interested in emerging markets, which would benefit from the neutral to weaker dollar and from the disparity in valuations that everybody's sort of talking about now. So we're a little tilted more towards the reflation trade in the hope that we get something done on the tax side. But should that look like there's really no opportunity there, then I think people are going to want to rotate back into what's worked in sort of a neutral, weak dollar environment, low growth, low inflation, low interest rates. You know, same boring stuff we've been used to for the last few years.
If we get tax reform, all right, it's the David Pepper trade. You buy everything.
Yes.
The market will go. That's really what it's all about.
Right.
Yes.
If we don't, you sell everything. So it's pretty binary at this point.
That's not exactly
really
the Tepper trade is a no-lose trade. The Tepper trade is, you know, tax reform goes through, you can buy it. It doesn't go through, you know, quote-unquote, the Fed will buy it for you, and you're fine either way. Jack, do you see anything like that? Are we in that kind of Goldilocks environment now?
Yes, I absolutely do. It's a question of whether we see the market dip 7% before that. Either way, you're going to see this administration and this Congress do something. It's only a question of the velocity of change, and that'll determine how fast we go up.
Steve, I'll give you the last word here. We had pretty good gains for the first quarter for the major averages, especially the NASDAQ, are up roughly 10%. Can we do that again in the second quarter? What do you think?
If we get tax reform, if we get any type of tax stimulus plans, I believe we can. The problem is, Jack said it, David said it, you look at valuations in this marketplace right now, they're beginning to resemble a lot like 07 for me. That makes me a little bit scared going into the back half of the year, into half of the year. So
yeah,
for me, I'd rather take chips off the table.
But Steve, you were not saying that the strong performance of some of those big cap techs is a tax trade, right?
It could
be in the first quarter, because it sounds like it's more what David was laying out. Yeah, the weaker dollar, emerging markets doing well, and he said that was the opposite of the reinflation.
Sure, but it's also a tailwind too. You have billions upon billions overseas. If those companies bring that money back here, I think that is bullish ultimately for U.S. equity. So yeah. I think that trade has a number of levers that it can pull.
All right. Good discussion, guys. Good to see you all. Thank you for joining us today.
Thank you.
Thank you.
Appreciate it.
Tax.
All those things are relevant right now.